Today, I have the pleasure of speaking with Christopher Berlet from MineralFunds. Christopher, you do an annual ETF fund. Can you tell us a little bit more about it?
Hi, Tracy. Yes, it's a third year now. We're tracking the ETFs. We track them in metal and mining ETFs worldwide, and we track them in their native currencies. We have currency conversions in real time. We track number of issued shares, so we can see the assets and the movement of capital in and amongst these metal and mining ETFs. So we've been doing it. This is our fourth year, our third year that we've published, but we're coming up on 4 years worth of work in doing this. And today, at the end of 2025, we tracked 249 metal and mining ETFs. And in early December, and again now, or sorry, later in December, around the 20th of December, assets passed 750 billion US dollars. Then they went down a little bit in the last 2 days before the end of the year, but now they're up again above 750 billion US dollars. So three-quarters of $1 trillion in these metal and mining ETF assets.
Would you not argue that some of these numbers are nothing short of exceptional? I was looking at the world metal and mining ETF assets from 2024 to 2025, and they almost all have 3+ digits, 108%, up 199%. Can you tell us what you can attribute those staggering numbers to? Because they're staggering.
Yeah, very dramatic growth. Again, this year, 117% growth in total assets in in 2025. And the principal contributor to that is the gold and silver ETF. So gold assets, gold ETFs, 79 that we track, gold ETFs around the world, have assets of 500 billion US dollars today, above 500 billion. And silver, we track 21 silver metal ETFs. Assets went from 25 billion last year to 75 billion at the end of 2025. So a 200% increase in total assets in silver metal ETFs. So that's the biggest driver. But there's across the board, there's increases in number of shares outstanding, showing capital allocations increasing to the sector.
Your report had some very intriguing information. One of the pieces of data that I found very intriguing was it seems like the New York Stock Exchange is way ahead of everybody else. You would think that the Toronto Stock Exchange, with all the mining companies, would be leading in these metal ETFs, but the London Stock Exchange and the New York Stock Exchange are leading the pack. Can you tell us a little bit more about what you discovered in writing this report?
Yeah, definitely the New York Stocks, News, NYSE Arca, and London Stock Exchange together host about 75% of the assets. Those two exchanges in all the 249 metal and mining ETFs worldwide. So in the U.S., NYSE Arca is more than half, 55% of the assets worldwide. So definitely those are the dominant exchanges, and the dominant products are metal ETFs. So metal ETFs make up about 85% of the assets. Further 12% roughly are mining company ETFs, and then there's a smaller portion of 3% that's currency hedged, leveraged ETFs. So definitely those exchanges dominate, NYSE Arca and London Stock Exchange.
Now, you touched on this in your last answer, and you had broken them down into 3 categories. Can you explain what those 3 categories are?
Yes, 3 categories, each of which has subcategories. So there's metal ETFs, and that represents almost 85% of the total money, the assets. And so we're talking about gold, silver, platinum group metals, critical minerals, and industrial metals are the that's about 85% of the assets in total. Then another 13% are mining company ETFs. There's 56 mining company ETFs with around 12% of the assets in total, just about $70 billion in total. And then there's about 60 what are called hedged and leveraged. So the silver triple long, the gold double long, the inverse gold, inverse silver, or the miners leveraged. That's about 3%, a very small portion of the market. So metal ETFs, there's 133 of them, represent about 85% of the assets. And within that, gold and silver make up about 95% of that. And you get precious metals as a small portion, 2%, critical minerals, Looks like around 2%. Platinum group metals around 2%, and industrial metals. Gold and silver, 85% of the market.
So, what was the most intriguing trend that you identified while doing this incredible research?
We see new issues, 9 new issues in 2025. A lot of 5 of those were Canadian. So we see that 2024 we saw a lot of new issues in India and China, and the first in China for a metal mining for gold mining ETF. So rather than being metal ETFs, mining company allocations for the ETFs, and that's experienced very dramatic growth as we suspected it would through 2025. But I guess the biggest indicator for us is the growth in the number of shares outstanding. So we see really substantial growth in shares outstanding, and in particular into year end in the inverse in the short positions. You can really measure investor interest because by looking at the number of shares outstanding, that represents capital flows more accurately than price changes.
So, if I have you dumb down that answer, you're saying everything was up. Is that correct?
Except for the stuff that was short. Yes, everything was up dramatically. Silver, the most dramatic. I mean, and some of the returns were quite outstanding. I mean, if you look at the leveraged longs, we had returns almost 500%. So the Direction Junior Gold Miners Index Bull 2 times, that was up 466%. And it's interesting. I did this little thought experiment, Tracy. So there's a Direction Junior Gold Miners Index Bull 2 times. It's up 466%. Now, Direction Junior Gold Miners Index Bear 2 times was down 91%. Okay, so it's almost the mirror image of the other. But do a thought experiment. If you take $50 and put it in each of those at the beginning of 2025, what's the outcome? Well, the one that was in the bull 2 times went up 466%. So, a 5x on $50, basically $240 valuation. The one that was in the bear went from $50 down to, it decreased 90%. So it went down to $5. So in aggregate, you've put up $100 worth of risk, and your total return, if you bought equal amounts of both of those, was 240, was significantly up on the year. It shows a volatility undervaluation in those leveraged long and leveraged short instruments. So dramatic movements in prices, 9 new issues in 2025, and a trend towards increasing management fees and actively managed ETFs. It's clear that capital markets are allocating bigger and bigger quantities of money to this type of investment instrument, and the asset managers are getting into the trend and creating actively managed ETFs. This year it was Sprott, last year it's Dynamic, so we see that trend, and we see the dramatic new issuance of silver ETFs last year in India and China for gold ETFs, Japan, and even Korea. So it's very informative about metal mining markets worldwide by looking at ETFs and capital flows.
This is quite the tool that you share with the public. It's my understanding you can access this on mineralfunds.com. Is that correct?
Yeah, we have all the ETFs there. We have them categorized. We do real-time pricing in the native currencies, and we do currency conversions into US dollars.
And so if someone wants to get a hold of you, Christopher, how do they get a hold of you to ask you questions about this
Through the
ETF?
website. Through the website, Tracy. I'm very accessible. I have my phone, my emails, etc. Always happy to talk about this research. It's very informative. Provides great insights into capital flows in the metal markets worldwide and metal and mining ETFs. And another one of the conclusions is, and there's a number of things that you can see, but one of the most profound implications is that this is dramatic. This is create very serious inflation pressures. You buy ETF, you buy metal, your metal goes into a warehouse. In the case of nickel, for instance, you're competing with nickel. For that, you're competing for nickel with a consumer of nickel, like a battery company or a steel company, or those that are that have requirements for nickel. You're buying nickel in an ETF, and that nickel is being stored effectively in a warehouse. We're talking about enormous volumes of money now directed towards ETFs, where these assets are being stored, and to some extent, at least some measurable extent, that money, that capital allocation has come from investment in exploration, which is therefore, providing less capital, has done over the last 2 decades since the ETF, since the first advent of ETFs in capital markets. The capital flows have gone towards metals and warehousing rather than towards exploration and increasing supplies. So, that has, when you follow the logic through, it has dramatic implications, inflationary implications, and it also has resulted in under investment in exploration, which is now evidenced by lack of new supplies, lack of new discoveries, increasing head grades for gold mines, for copper mines, in the first 2 decades of the century, and a number of the other trends that are quite evident to those that are involved in metal and mining markets.